Good morning. Welcome to ANZ News, Friday, the 30th of July. Today we're talking negative real rates to stay. Music to gold's ears. Concerns of the Fed tapering its QE program or raising rates were largely alleviated this week through the couple of events in the US worth noting. First, we had the latest Fed meeting 2 days ago, which for many was just plain confusing. This from Mohammed A. Al-Arian. I suspect that many may agree that this was one of the most confusing Fed press conferences. Where there may be disagreement is why, particularly the balance between genuine economic uncertainties and what behavioural scientists call active inertia or too deeply wired convictions. Why? When one is as trapped as the Fed, one needs to duck and weave. But probably the clearest takeaway is that they are keeping the pedal to the metal with monetary stimulus, almost completely discounting inflation concerns, and so putting in all their maximum employment mandate, where they need substantial further progress before any tightening. Now that may seem strange to you when their headline unemployment figure is so low, but that discounts those that aren't actually being counted through participation. This week we saw many or more disappointing jobless claims data, coming in worse than expected for a second week and on the rise. For context, we're going to show you the number of Americans still on some sort of dole, their green and blue COVID relief payments, rising above 13 million again after a gradual fall from the mind-boggling 33 million in the initial lockdowns. Here's that chart here for perspective. And then last night we saw a disappointing Q2 GDP print of 6.5% when 8.5% was expected. Yes, that is a huge number, but remember the base effect for a year-on-year percentage when the US was in the depths of the deepest recession in the history a year ago. 6.5% is also stalling, given last quarter was 6.4%. When looking at this, we must remind ourselves of the context of the three core economic metrics of the Fed balance sheet as a proxy for new money supply, on GDP as a measure of real economic growth, and the US share market that in theory should dance around the GDP lines with unders and overs as it cycles. This next chart we're going to show you so clearly illustrates the grotesque disconnect between GDP and the entire US share market. Here's that chart here. Blind Freddy can see the impact of the monetary stimulus in red, pumping the share market in blue beyond fundamentals around GDP in green. That there is an historic positive correlation between the price of the share market and unemployment means the temptation is to continue. This, of course, exacerbates the already deeply socially disturbing wealth inequality gap issue around the world. Chart author Sven Henrik of Northman Trader explains. Why? Because popping the largest asset bubble ever would result in a catastrophic reset, not only in recession but in a depression. The reality is debt levels have so exploded in the past 13 years, any pre-GFC type interest rates, which were historically low back then, would collapse the entire system. They know it, I know it, you know it. The entire system is predicated on debt expansion and cheap money to sustain it. And that's it. The only way to avert disaster is to keep expanding wealth inequality, disconnect asset prices from the economy even further, and keep telling everyone they do it for the downtrodden, while the bottom 50% are the ones actually taking the bath with permanent price increases, while their wages just aren't keeping up. How? Well, as the legendary Mohammed A. Arian observed, the Fed will most likely continue to disconnect asset prices even more from fundamentals. Wealth inequality will worsen more. The Fed's monthly purchases of $40 billion of MBS or mortgage-backed securities will continue to price people out of the housing market. In other words, and Sven's to be exact, asset price inflation for the rich, consumer price inflation for the poor. History is littered with broad-scale social revolts and ensuing resets when this distortion reaches tipping point. The inevitable outcome, too, is prolonged negative real interest rates. Deutsche Bank credit strategist Jim Reed recently plotted the history of the US 10-year real yields, or nominal yields less inflation. TIPS, or TIPS, only go back to 1997, so we used a combination of subtracting spot inflation from spot 10-year yields through time, and likewise a rolling 5-year average of inflation from spot 10-year yields. The following resulted chart shows we have not seen such extreme negative real rates in 70 years. Where to from here? In his words, I've been on record over the last few years as saying that with debt so high, your real yields are likely to stay negative for the rest of my career. as the authorities have to control funding this rising leverage. I'm even more convinced of this post-pandemic. And positive US real yields for any length of time would likely set off debt crises around the world, so we're probably stuck with the regime. Even if the Fed lose control and yields rise, the accompanying inflation will keep it stuck. To wit, real yields will notably be negative, followed by a view that inflation will be higher going forward than it was over the last decade. One of the most highly and negatively correlated relationships you will see is the gold price and negative real yields. As we discussed yesterday, the gold bull market is likely just getting going. Here's that chart here to finish off news for today. Look at that massive disconnect there. Well, everyone, we hope you've enjoyed our week of news. Remember, after the physical stuff, over to anzbullion.com.au. Cryptocurrency is your fancy. Jump over to anzwealth.com.au. And if you're after our cryptocurrency built and backed by real gold and silver, stored at Reserve Vault, check out goldsilverstandard.com. Enjoy your weekend, everyone, and we'll catch you tomorrow, Monday, for more news.